Good evening. Welcome to the Hurley Investments Market View commentary for Monday, November 29th, the last one we'll have before the end of the month. I'm going to go through that in a second. We'll hide that for a second, but really quickly, a couple questions that came in for me right now. Why is our market moving so much higher? And some of you are kind enough to say, hey, I don't believe it. I don't trust it. We understand that. We somewhat agree with you. And if I just said the 27th instead of the 29th, welcome to the Market View commentary on the 29th. Thank you, Bill. But why is our market moving so much higher? Which means last 30 days, it has been up 10.61, and Hurley Investments has been up 11.39. And that's kind of net. But I made the comment to you, someone tell me, why is our market moving higher? And there could be several reasons, but there are a couple in general that I think we should be counting on. So who said that? Retail sales seem to be good. The retail sales were down 0.1, and retail minus autos was up 0.1. Both beat the expectations. So I'm going to say the seasonal sales cycle is intact. Cannot spell. And what I mean by that is, even with all the problems, and I did find this somewhat interesting. Where is it? Black Friday shoppers spent a record $9.8 billion in U.S. online sales, up 7.5%. Now, credit to my wife. My wife made the comment, isn't that just inflation? And to a certain degree, yes, that is just inflation. But to Russ's comment, the consumer still seems to be spending. Can anyone tell me what we're using to buy these items? Credit cards, there you go. Over $1 trillion in debt for the average consumer. And to be honest with you, it would take me about technically 2.5 months or 2 months that I could have all my credit card paid off. But it's debt. Not only is it debt, it's debt with the highest interest rates in the last 16 or 17 years. I don't know for sure how long it is, but it's ridiculous interest rates. If you're running up a credit card right now, it should be your goal to have that paid off ASAP. Now, someone said, doesn't it bode well for brick buildings? And I'm going to read one comment that was made because I found it interesting. Just at Best Buy trying to buy a range and everything was sold out. They didn't know when they'd have merchandise or not taking names for when they would arrive so that you could buy one. So just so you know, that came from the East Coast. Out here, some of those durable goods, like at least in Utah right now, I don't know about ranges, but freezers, air conditioners, and freezers, air conditioners, refrigerators are still lacking here. It is easier to drive down to Southern California or even to Las Vegas. That's where I purchased my newest freezer for meat coming in from the cow slaughters. I could not get one here. I could not get one in Idaho. It was better for me to drive down to Las Vegas to purchase my durable goods orders like that. So that is just something to be made aware of, right? I might also say, and let me go back up to see what I've missed. Retail seems to be good. Mag 7, earnings are better than expected. So that is also true, which is kind of surprising because that's a self-fulfilling prophecy, right? Earnings are slightly better than expected, which was a surprise. We were expecting them to be awful, but again, there was a lot of doom and gloom. And just something that you obviously do want to pay attention to and do want to know. Yes, the other reasoning is, how would I say this? Money managers playing catch up and the business cycle for an up year in the market. And I heard these on Bloomberg on Friday, so don't quote me exactly. But generally, you have the December prior hold on. December average is usually up like 1.4%. And the December prior to an election year is double, which is basically 3%. And I forgot there's something else that I'm forgetting here that I shouldn't be. December average up 1.4, and the December prior to an election year is double to 3.0. There's something else I'm forgetting, but for the life of me, I can't. Oh, I think it's that if the market was up double digits anytime in that year, you're going to see somewhere between a 4.5 to 5% December as these money managers play catch up. So, with that said, yes, we've let things run after earnings, but We are ready to place protection back on to get us through the December 13th FOMC rate hike meeting. Well, Kevin, the rate hikes the last couple times have been a positive movement on our stock market, and we understand that. But can someone tell me what the FOMC has not said yet that everybody wants to know? And a comment was made, probably not good for banks if there are credit failures. There are always credit failures, but banks don't make the majority of their money off of credit cards. That would be more of MasterCard, Visa, Discover Financial Services. MasterCard and Discover Financial Services and American Express were the 3 out of the 4 big ones that did have some late payments and failures. Visa did not. But what did we not hear that we need to hear? And Lee Maxwell got it exactly. This is the end of interest rate hikes. That is exactly what we're looking for. Now, the comment was made, we're on target to meet inflation levels desired. That is also correct, but that will probably not be something that we'll hear because mathematically, they're not there. Mathematically, we're looking at least a 3% to 3.5% inflation for the next couple of years. So we're just not going to get there. But that would be very nice to hear. And yes, they do want to hear that. But the key words are, this is the end of an interest rate hikes for an extended period of time, meaning 6 months or longer. And the question is, in fact, I should ask the group, are we going to get a rate hike in December, in January, or not at all? What do you think? A rate hike in December 13th, in January, or not at all? Understand the yearly interest. What we're probably going to finish at for this year is in that 3.6 to 4.3% range. So boy, we're pretty interesting across the board here. I've got 2 not at alls. I've got 4 Januaries. I've got 1 data dependent, and I've got 1 December. If you were to ask me, I would think December would be the one to have the rate hike. We've just had our markets up 10%. We're having a good year. Yes, we would give some back, but I don't think they want to start off next year with a rate hike. I think they want to finish it in this year. I actually felt it should have been last month. So please don't use me as your precursor or your indicator that, hey, if Hurley says it, it's going to happen, because that is not true. But it does make me wonder when that rate hike is going to be. And plain and simple, we have stretched out long enough. I would expect us to be adding protection immediately. The Dow Jones Industrial Average rarely stays overbought. We can see back in July, we hit that overbought and we basically lost 10%. That would coincide with market averages for us to come down. We're already at the R2 level on the S&P, which means we're over 1 standard deviation away from the 50-day simple moving average. It would require roughly about a 5% drop to come back in line. So we're looking to add protection on very quickly. Same thing with the S&P 500. We're still bullish, but we're overbought. And we've been overbought now for a week, basically. If that doesn't look like a top, I don't know what is. Expectations will come back down almost 10%, probably closer to 7.5%, to touch that 50-day before we move higher in January. And same thing for the NASDAQ. It is willing to stay overbought a little bit more, and it probably won't have the drop down that the Dow and the S&P will have, but it also is above that R2 resistance level. It's more than one standard deviation, and the market usually will not stay that far out of bounds, meaning there are going to be some profit taking, and the excuse will be the rate meeting December 13th. It might not matter what they say. They don't have to say anything. It might just be time for some profit taking and for some people to say, hey, we're done with the market and here we go. So what do we do to fight some of the seasonality? When we come into the seasonality, or I should say, what does HI do to fight the seasonal sell-off end of year? Any ideas? For those of you that have been around a little bit, you should know a couple of these, which I'm going to say are glaringly obvious, but might not be there. Protection, all right. That is definitely one. Those long puts, I like both of those answers. Any other ideas? If Abraham was here today, he'd probably tell us. Definitely add puts, protection, put protection. You guys are very familiar with that. But we do a couple other things as well. So one of them is that we invest in Baidu. We invest in Baidu where you will see us playing something outside of the US typical norms. We love Baidu because historically it'll run the first quarter of the year, and historically it'll run June, July, and August, when you sometimes have that sell in May and go away. Baidu is one that is different than the US. So we're playing a position that is different than the US. And the other one in the past has been Disney. Disney is also a January, February, March pop, and a not June, but it's more of a July, August, September, October move. So those are a couple things that we do to make sure you're in a position there to be profitable in some of these down times in the market. Okay, let's see. Someone asked, go through a typical day. And so I'm going to go through this, and I'm also going to bring a couple comments to you guys. Typical day, I'm up between 5:30 and 5:54, 5:55. I wake up, and in winter, I start the wood burning stove, get a hot chocolate going. In summer, I'm out on the back porch enjoying the sunrise. I might crack open a Monster drink to get myself going. From 6 to 8, I call it catching up on news. I've got a CNBC watch list that I have on a CNBC app. I have it in the Google Finance, I have it in Yahoo Finance, and I have it on FinViz, where all I'm doing is looking at general news that I missed from when I went to sleep, and I'm trying to read any news that I missed yesterday on stocks that I'm actively in or stocks that I feel I may be in the near future. Can someone tell me why else is it important for me to be watching the news between 6 to 8 a.m. in the morning? Something happens every day in that 6 to 8 a.m. time period. So why else am I going to make sure I'm up an hour and a half before the market opens? For me, the market opens at 7:30 Mountain Standard Time. And these are Mountain Standard Time times, right? What happens between 6 and 8 or 8 to 10 Mountain Standard Time that should make me be up and paying attention to it? And it happens almost daily. It's not overseas market. The European doesn't close till later for me. There we go. Perfect, Mod. Government reports. I am watching these government reports. I usually go through briefing.com. And all I'm doing is taking note. Like new home sales today that made us worry. It was really hard to sit through that first hour to see the futures and E-mini clear out. But we missed the new home sales by, boy, roughly 61,000 homes. It was a big miss. But they revised 40,000 into last month. So because there was a big revision that boosted last month, it got overlooked. I am watching these reports. It usually happens somewhere between 6 and 8 a.m. every single day. I'm paying attention to how these move the futures. I'm paying attention to their impact on the stock market. For that reason, I am 99.999% of the time awake and gathering information from 6 to 8 o'clock. From 8 to 9:30, I call it working numbers. And all I'm doing when I'm working numbers is I'm just seeing how those economic report numbers are affecting the stock market. I might, on a bad GDP number, rework the S&P 500 earnings. I may rework the GDP numbers. I work numbers that I see posted online to verify if these idiots even know what they're talking about. A lot of the times you see numbers pulled out of thin air. If I can't verify those numbers with FinViz and or if I can't verify those numbers in FinViz is my first spot I'll go to, on Yahoo or Google Finance, maybe through the broker that we're using, then I'm not putting any credence to the BS that people write. And a lot of what's being written out there right now, a lot of what I'm seeing that some of you guys are sending to me, a lot of you are reading marketing material that is not exactly accurate. This time of the year, you'll see a bunch about gold and silver. This time of the year, you'll see a lot about 10K reports and so forth. But that 8 to 9 o'clock time period, I want to see how those economic reports come out and how they affect the market. And really that's my working numbers hour. I am working numbers that are published from people that I've read stuff from. I'm working numbers on trying to calculate the way that they come up with their numbers. I'm working earnings numbers. I'm looking through numbers on a scheduled 10K. I'm spending my time doing the best I can to verify what I read. And usually from 9:30 to 10 o'clock, I take my breakfast and I shower. That's how I'm working the first part of my day from 5:30 to 10 o'clock. There's 5.5 hours that I've put in by 10 o'clock in the morning. 10 to 1. Primarily, I'm turning on the TV. And I usually start off with CNBC and I listen to them in the background, especially from 6:30 to 8 o'clock in the morning, their Squawk Box. I then usually shift it over to Bloomberg. From 10 till 1 o'clock, I'm watching Bloomberg. I'm listening to Bloomberg. That would probably be a better way to say it. I'm listening to Bloomberg. They're the most boring that will use numbers and give the most bland, boring reports on what's going on in the day. I've noticed Fox News, I noticed CNBC, CNN, right? They all have these outlandish, weird, emotional, tear-jerking, freak you out type of programs. And that's not what you need to be listening to. It's really show me the numbers. So primarily from 10 to 1, I'm listening to Bloomberg and I'm doing some kind of paperwork. I'm doing phone calls. I'm doing SEC work. I'm doing some of my own marketing, some getting back to people. That's usually what I'm doing from that time frame. But from 1 to 2, I'm watching the most important hour in the market, the closing hour of the market, whether it goes up or down. Most of the time, if we're placing trades or closing trades down, it's done in this last hour. This is where we're taking profits from puts. This is where we're rolling puts. This is typically where we want to add protection. We almost did it today because we've got so many positions that are overbought with a market that's overbought. I can't believe we're stretching it out to one more day. I can't believe what we saw the last hour of the market where it actually got stronger, but I'm always in front of a computer. So I should say watching the closing hour of the market in front of a computer. And this will happen anywhere. My wife hates it. I'll walk out of Disneyland or I'll walk from the beach and go sit in my car for this hour to make sure that even on a vacation, I'm never on a vacation, that last hour, I'm always in front of the computer. From 2 to 3 again, that's where I'm working numbers. And I'm going through what I call 10K reviews. It'll take me a couple days to go through something like Disney's 10K. And this particular one, I thought it was like 89 pages. $129. So this is something I don't get through in a day. And yes, Bill, when you sent me the email that you sent me, yes, I was noticing that same thing as I was going through Disney Schedule K. And all I'm doing here is I'm reading through it to find some things I didn't like that Disney was saying. I found it rather interesting, and Bill pointed it out to me from someone else that found it before I did. It's hidden right down here, and their justifications for why they're not doing good. Their third bullet point down, customer preferences and acceptance of our content offerings, pricing model, and price increases in the market for advertising, sales, and direct consumer services and networks. In a roundabout way, they are saying that customers do not like their woke stance or the movies or products they've been putting out. Wish came out at only $31 million when it's supposed to have somewhere between 45 to 55 million. They have not been doing good with their Marvels movies. Their last one that came out called The Marvels. So I just found a couple things that are interesting, but it will literally take me 3 or 4 days to work through their numbers. How are their numbers compared to last year? How are their revenues coming in this year? What are their operating expenses? Are there discrepancies? Are they getting better? Are they getting worse? This is what I'm doing from 2 to 3. Primarily, I'm usually going through all of the Schedule Ks from anything that we trade. And if I'm going through anything that we're trading, or that we might be trading, for us at Hurley Investments, Google Finance, it's going to be at least 21 active traded positions, and more often than not, it's 49. So it's our 21 active positions that anyone that's with me is in, and then I've got another list of 49 that for a 3-month period of time, I'm going to spend about somewhere between 90 to 100 days going through a Schedule K. And I'm just looking for problems. I'm looking to verify if these idiots that are trying to throw numbers out have a justification or not. Some of the bigger ones, Google, Meta, Apple. You can have a 300-page Schedule K for Apple. It's huge. That one might take me a week to get through. But this is where I'm spending my time. And last but not least, I'm sorry to admit it, from 3 to 4 o'clock my time, yes, I watch Kramer on CNBC with Mad Money. And it's not that I like or I agree with what he's saying. It's just he is the most watched financial show. And if 11 million Americans are watching him, it's probably something I should be paying attention to see what he's telling people. A lot of the times in summer, I'm listening to it on Sirius radios. I'm taking kids to school. So in all honesty, from 6 o'clock in the morning till 4 in the afternoon, there are 10 hours right there. And that 10-hour group, I'll have a half-hour breakfast shower from 9:30 to 10. And that's what I'm doing every single day. That's my Tuesdays to Fridays. On Monday, obviously from 5 to 6, I'm preparing notes. And from 6 to 7, I'm giving you guys a webinar. Mondays are a 12-hour day. Sundays, I'm going to spend 2 hours going through my planner, updating my numbers, seeing what we have coming up in the next 6 weeks by way of economic reports and earnings, seeing what earnings change. I spend a couple hours Sunday evening preparing for Monday morning. This is how I spend on average 54 hours a week. This is my 54-hour a week work schedule. And in all honesty, it doesn't change. If I'm on vacation, I'm going to miss, I'm going to miss sometimes the 8 to 1 o'clock, that 5-hour gap. But even on vacations, I'm still up early. I'm still finding out what's going on. I'm still in front of a computer. My wife hates it. She knows from 1 to 2, I'm busy. Even on vacation, I'm busy. Pretty neat because my Alaska fishing place now has internet, so I could even do work when I'm up in Alaska fishing. Pretty interesting. I did not go over this with you last week. It's the same one. The last answer might be the one that matters most in terms of meaning and opportunity. It means investors think forward earning estimates are too high, so it looks like a value today isn't the value it appears to be at first blush if there's going to be a material downward revision to earnings estimates. According, investors default to mega cap stocks, which they expect to be more dependable in a more challenging earnings environment, an economy in recession being considered a challenging earnings environment. So it's funny because we actually thought we were going to be in a recession this year, right? We were expecting 2 back-to-back down years. And finally, someone said it. The mega cap stocks are where this generation feels the protection the value is in. It's no longer the S&P 500. It's Apple, it's Nvidia, it's Microsoft, it's Google, it's Amazon, it's Facebook, it's Tesla. You could throw a couple more in there, but protection is no longer the S&P 500 blue chip. It's no longer the S&P 100. It is the mega caps. And think about it. Would you rather be an Apple than Disney? Would you rather be an Apple than General Motors? Would you rather be in Facebook than General Electric? Than Pfizer? Than International Paper? It's pretty interesting to see that that push towards these companies. Now, 2 comments just came in. I found them very interesting. The first one, is that similar to the 2008 with the tech bubble? No, because 2008 was a financial bubble. But 2001 and 3 could be your tech bubble burst, right? 2000 was the new millennium and computer coding, but the tech bubbles were like 2001 and 2003 or earlier. And is it similar? No, it's not similar because you have the earnings behind the tech bubble. You're not looking at the WorldComs and the dot bombs and so forth. You have real earnings with companies like Apple that have billions of dollars set aside. So is it similar to the 2001, 2003 tech bubbles? I think they're vastly different because of the cash on hand on those tech companies. And the second comment is similar to it. So is there a bubble within those 7 to 11 stocks? And that's one where I can scratch my head because some of them I think have come too far too fast. Amazon doesn't have the earnings that garner its high PE. Nvidia does not have the earnings that garner the high PE. Could there be a bubble in the mega caps? Possibly, but if you're to ask me about Microsoft and Google and Apple, Tesla's obviously in a bubble, but what's the other one I'm forgetting? Facebook. The numbers don't warrant a bubble worry. Is there too much being invested in it? Well, if you look at Apple again, you've got a doubling of the volume in the last 2 years, partially because of Buffett and partially because that's what people are looking at. So the short answer there is, could our mega caps be in a bubble? At least 4 out of the 10 or 11 that you would bring to me as a mega cap are bubble-licious, right? But I think as a whole, their cash on hand and their earnings make them significantly differ from a 2001, 2003 tech bubble. I believe it also differs because of the valuations and fundamentals are more justified than the most recent tech bubbles that I can think of. Good questions, both of you. All right, going through this week. Went through those. Light on earnings. This is the last week of retail, finishing with Crowd, Hewlett Packard Enterprises, Intuit, and NetApp. Dollar Tree, FL is a sneaker company. I'll come back to it. Five Below, Salesforce, Snow, which is the new tech company, Big Lots, Kroger, Ultra, and Dell on Thursday, Genesco, the insurance, on Friday. Economic reports, our big day is going to be on Thursday, where we have personal spending, personal income. That'll be the big one that you need to pay attention to. Yes, GDP will matter, but not as much because it's our last quarter. Our GDP usually looks good this last quarter because people are spending. Interesting article on how Sam Altman is returning to CEO and everything all of a sudden is okay. Buying opportunity from news on Microsoft because of this. Really hard to buy into weakness. I still have the Biden and Xi's meeting sent an important signal to business in China, which is why we should expect to see a rebound in Baba, Baidu, Tencent, the big 7 or 8 mega caps over there. I put the Baidu earnings on here so you can work some of those same numbers I'm seeing. And where it hasn't gotten any love for the last year, so I would expect a pretty big bounce in the next year because it's behind. It hasn't got the bounce for the last year and a half that it should. Black Friday shoppers spent the record. I went over this one with you. Something to read through. And a little bit on the movies that came through. It really is a knock on Disney movies, but I want you to see what's out there and what's making money versus what's not. With that said, what questions do you guys have for me that I can answer for you? Any questions you guys have that maybe I haven't answered for you? Spencer, nice to have you here. Just to let you know, Spencer Ellis will be another registered investment advisor with Hurley Investments. He is also an insurance. Spencer, how would I describe what you're doing? Insurance, Medicaid, Medicare kind of guy. If there's a way that you need some help in that, he might be your guy, but he is extremely busy between now and the end of the year, getting everybody back into their insurance, Medicaid, Medicare programs. And again, Spencer, if I'm saying that wrong, type something in for me, please. But Spencer Ellis is another registered investment advisor that's working with Hurley Investments. And Spencer, you can't see it, but Jim just said, welcome, Spencer. Dave and David are both in. They're my regulars, and they both said welcome as well. So you've got 3 people welcoming you to the Hurley Investments crew. He's an insurance broker. Spencer's an insurance broker. So if you'd like help or want to use his services, Hurley Investments has an insurance broker back with us again. Thank you, Spence. All right, any questions you guys have that I can answer for you? Hopefully I'm giving you guys enough information to help understand what's going on and to better understand why we're running your positions. Yes, we've been through 4 weeks with little to no protection. We're ready to get it back on because technically speaking, we're overdue. We're overdue for a pullback. It's getting harder and harder every day to sit on my hands right now. So our first down day in the market, understand we're going to be having protection on for the rest of the year, and we just about hit it today. It really fell away the last half hour of the market today, but we're close. We're close. We're going to be adding protection on soon. All right, I don't see any questions coming in. If no questions are coming in, guys, have a wonderful evening. Stuart. Stuart, I will call you back at the top of the hour here in 10 minutes. And with that said, guys, have a wonderful week. I'll see you next Monday. We'll have 3 more of these after this week on December 18th. We'll be gone again till January 8th. You guys take care. Have a wonderful day. I will talk with you soon. Bye-bye.